Are you frustrated with taking too many losing trades? Or how would you like to avoid some of those losing trades and stuff your trading pockets with more winners instead? Well, today we're going to share 3 effective tips you can use to get more winners and take less losing trades. Plus, you'll discover how you can extend this process to any market using a surprising tool everyone has access to. So what is this tool and what are the 3 tips? Well, welcome to Breakout Trading Answered, the show where we talk about all things breakout trading. And joining us today is Mr. Breakouts himself, Thomas Nesnedel. Welcome, Thomas.
Hi, everyone. Very nice to be back.
Now, I'm getting double audio in my earpiece. Thomas, I don't know if you are today or
No,
not.
I am not.
Maybe it's just
I don't know
me.
what's going on.
So I'm just going to try and figure it out as we go. But yeah, losing trades. How to avoid losing trades, Thomas, is the topic for today. So it's a very exciting topic. But why have you decided that this is a topic we're going to talk about today?
I think it's quite obvious because a lot of traders are frustrated with their losses. And, it's quite surprising because there are plenty of techniques to cutting false entries, as you already know. But some techniques are surprisingly easy, and it all comes back to basics and to the foundation of the trading craft. And that's what I would like to talk about today, because some ideas are really simple, obvious, yet very powerful, and can help immediately with reducing the number of losing trades.
Excellent. All right. Well, let's just say hello in the chat. G'day, Chris and Mark. Welcome. Hey, John. I just want to know, is everyone's audio okay? If you can just give me a yes or no in the chat, because I'm having some weird stuff going on. I'm hearing echoes today, so hopefully you guys can hear us okay, and Thomas, you're okay as well, and we'll just push through it. So let's get started, because I'm really excited to hear what these 3 tips are and what is this special tool that you've been using, Thomas, that everyone has access to. So I'm keen to dive into it today.
Right. So as I said, this is going to be quite essential, yet quite elementary and important. So, the real question of today's show is if there's a proven formula for traders to avoid too many losing trades, like we have on the next slide. And yeah, there is. There's obviously not just a single one formula. There are a couple of formulas. But the very basic and the very key core formula is, and if we can move to the next slide, I'm going to reveal it. The next one.
It's coming. There we go. I think you're freezing, Thomas. We're definitely having some tech issues with streaming today.
Oh, really?
Yes.
I'm here.
Or maybe
everything
it's me.
working smoothly here. Yeah.
Okay. Yeah. Excellent. Well, let's keep going.
Right. So the formula, guys, is really, and it's coming. It's coming. Technology, always something. The formula is really know your market. And this can sound a little bit overwhelming, but I will show you 3 exact steps explaining what I mean and how these 3 simple steps can immediately help you getting better results when it comes to reducing false entries. So the way to know your market. So first of all, if you know your market, that's the point that how you follow the money. And how you follow the money in your market, it comes basically to only 2 major points. And I call these points 2 T's. It's not Thomas. It's not Thomas and Thomas. These 2 T's are tendencies and timing. And each market is very specific. Each market is very individual in tendencies and timing, 2 T's. And if you do just a very basic analysis of those 2 T's, then you immediately can start improving your trading strategies and experiencing less amount of losing trades. So, Andrew, you said at the very beginning that I'm going to reveal a simple magic tool that I use for this kind of analysis.
Yes.
A tool that everybody has got access to. So I think we can reveal it. And that tool is guys, it's coming. Number, it's Excel spreadsheet.
No way.
And it's very timely to talk about Excel spreadsheets because just recently, last week, I got a question on the live hangout, a BTA live hangout, which we have with other great traders. The question was, how do I utilize Excel spreadsheet? Because I mentioned I utilize it quite a lot, and that's exactly how I utilize it. Try finding the two T's, the tendencies and timing. And I'll show you three very, very simple tips right now, which you can start implementing since the very beginning right away. So the very first tip when it comes to following the money is basically directional bias. This is about the tendency. This is the tendency. With every market I trade, I do a simple analysis in a Excel spreadsheet where I simulate what would happen if I buy open of each bar and then sell the close of each bar, or if I sell short the open of each bar and then buy to cover at the end of the day. So it's basically a simulation, which is a very simulation because first of all, you have a huge sample size. If I do this on 10, 15 years of data, I have 4,000 trades because this simulation happens on each bar. And then that's a very, very big sample size. And I can derive a lot of interesting insights from this basic data. And the very first thing I'm looking at all the time is the directional bias. And you would be surprised how strong directional biases are, not just in indexes, but in any other market. So it is the tendency. And so, for example, in Russell 2000, if we have a look on daily data since 2007, we can see that the directional bias is towards the long side. If we would be buying every bar on open and closing at the end of the day, we would make 0.15 points on average every day. Now, this is not a strategy. We're not considering any slippage commissions. That's not the point. The point is the directional bias. And this is very essential because if we do this analysis, we can very quickly find that some markets have directional biases so strong that just by doing one more thing, and that is trading with this directional bias, you're already mitigating a lot of false entries. It doesn't mean you cannot trade the other side. So, for example, here with the EMEA Russell 2000, I'm not saying you only trade long side, but I'm saying if you're experiencing too many losing trades, maybe you're trying to go against the odds. Maybe reevaluate your short side or switch it off for a while and stay with the long side only and see what happens. Because we have to honor the directional bias with each market. And that alone can already, we don't want to go against it stubbornly. That again can help us. So very simple. You can do it in Excel spreadsheet. And we know the basic tendency. That's the first tip to follow the money. And again, every market has got its bias, and some markets have super strong biases, not only indexes.
So what do you do about markets that have a bias that switches from time to time? Because indexes here, they have a very heavily long bias over a long period of time, but other markets might be a little bit more balanced. So what do you do about those?
That's a good question. So let me get back to these indexes because it's a little bit tricky one. So Andrew, I think I can foreshadow already that we're coming up with something very special for November. And in November, we're going to have a special topic, which will be index trading. And, you know, everybody thinks that index trading has got a strong long bias, like I just showed you in Russell 2000. Well, next month, I'm going to show you it's not the case. I will show you some really surprising results, which kind of will burst this cliche a little bit. So every market, including indexes, they have their periods where the bias, the regular bias might disappear. And again, this will be a surprise. You will see it next month. But what I do with the markets which are more or less neutral, then of course these are the best markets because you can trade them both sides. That's the ideal state, that you can trade them long and short, and that alone, the neutrality does already mitigate a lot of false entries. But overall, it's if you have so many false entries, start with honoring the directional bias.
Yep. We got a good question here in the chat from Shark Punch. G'day, Shark. Excuse me. I can understand why trading long on indexes worked well over the last years. What about the current market? Excuse me. I can see that kind of strategy struggling for the intermediate future.
Yeah, wait for the next month, because I'm going to talk about indexes more in depth. Next month, we're going to have this index special series, and I'll show you and I'll exactly explain what's going on and what we should do, because you're very right. By the way, you're very right. And we will go more into depth with that. But overall, I also can tell you, for example, so we're talking about these biases. So, for example, I can tell you, you would be surprised, but for example, last 15 years, most currencies, most forex currencies, and specifically USD, British pound, USD, Canadian dollar, USD, euro currency, and USD, Japanese yen, have quite a strong short bias. So as I'm saying, it's not just one bias in indexes. Basically, each market category has got its own tangible bias, and some markets have very strong biases, not just indexes. So let's not just relate this to indexes. That's not the case. That's why I say you need to know your market.
Yep. All right. Well, I'm looking forward to seeing that, Thomas. That's in November, is it? Index month is November.
Yes.
So look out for that one. So the first point there was directional bias. What's number 2?
So I said we need to tendency and time. And time is a very, very good overall indicator, or not just an indicator, but a pointer to improving your trading performance. And there are many ways to deploy time, but the easiest one and the strongest one always has been, and I've been using this for years and years, day of the week. And not only that markets have their own tendencies when it comes to long or short bias, but they also have very, very strong tendencies when it comes to day of the week. And this is quite reliable. With many markets, this is very reliable. And you can see, for example, here that I already mentioned that the average profit on the long side would be 0.15 points in Russell 2000, E-mini Russell 2000 to be more specific. Well, it can get up, it can improve by more than 300% if we isolate the long trading on Tuesday only, which is again very simple but very efficient way to reduce false breakouts, false entries in general, because we're talking here about false entries and narrowing down, knowing very well what the tendencies and timing in your market is, and then narrowing it down, or excluding the very weak days of the week. And again, on some indexes, you will find that some days of the week are losing money continuously. That alone can already improve your false entries quite significantly. So certain markets have days, even some indexes, they have days which are heavily short days. And just by excluding these heavily biased short days, you already can save a lot of false entries and improve your results significantly. So this is another thing that I like to do in Excel spreadsheet, to always have an overview of general timing tendencies, so I know where we stand and towards which timing we should lean and then improve our results. And by the way, this is a great proof. So this is again the same market, even Russell 2000, traded only on the long side, only on Tuesday since 2007. I mean, since 2007. Okay, so this includes the crisis 2008, and I think this is really, really crazy, because if you think about it, a lot of people and traders and investors, especially investors, are trying to beat the E-mini S&P market or the index market. Well, if you do just one simple thing, if you buy every Tuesday at the beginning and sell at the end of the day, you're already naturally beating the S&P market quite easily, because you're playing tendency and time in its very best. So this is not a strategy. This is we don't time our entries precisely. We do not any advanced analysis. We only play with tendencies and time, and if we play them well in our favor, we immediately slash a lot of unfavorable weak entries.
Yep, I think it's important to clarify this isn't a trading strategy at all. We're just looking at tendencies right now. So that's very important to understand. So Thomas, you mentioned 2, and I said 3 at the beginning. So is there a magical third?
Yes, it is. This one surprised me. This one really surprised me. And it's nothing magical. It's something very commonly used. So not only we have tendency and timing, but we also have some widely used techniques. And one of the most used techniques, especially in big institutions, when it comes to indexes, but also other markets, is using moving average, simple moving average. And I don't know how about you, Andrew, but I constantly hear about 2 different moving averages, either moving average 100 or moving average 200, period 200 or 100. These are the most commonly used by institution, banks, I don't know where else. And these are so much of a cliche that I almost ignore them for a long time. But recently I was quite curious because I had a meeting in Luxembourg with some bankers because of our hedge fund, and they were talking a lot about it. Was a couple of months ago, and that day the moving average to 200 was crossed down, and they said, well, we have officially bear market. And I said, okay, officially, what does it mean? Is it just because of some moving average? And then I got back home and I did a test on these 2 moving averages, 100 and 200. And I did the test on all the futures markets. Guess what? It does have some significance. I'm not saying it's a magical bullet. I'm not saying it's a golden nugget, but there was definitely more significance than I expected. So that's the third thing that can quite easily improve your timing. You just use one of these, I would say, master filters, which pretty much dictate the overall market trend at that given moment. It doesn't have to be necessarily moving average 100 or 200. It can be something else. But this is another proof that these techniques are simple, but they do work. So what happens if we combine the directional bias, which is the first tendency, with better timing, which is the Tuesday, and then with another directional tendency, which is the moving average 100. And we can see that all of a sudden, the average trade jumps by 656%. And on Friday it jumps up by staggering 1,017%. So these are, again, the tendencies that I'm always looking for in Excel spreadsheet. And once we have this overview of tendencies, then we can start really giving a very clear pointers to our trading strategy, when to trade or when not to trade. So these 3 tips are very easily and quickly implemented. And overall, if you have a strategy with too many losing trades, with too many false entries, well, all you can do is just modify it to honor the market bias, the market tendency. Second, consider the day of week timing and reducing. You don't have to have the entry every single day of the week, because some days of the week are weak and some of them are strong. And third, you shouldn't probably stay with your long positions when we have a bear trend. So just use this daily moving average 100 or 200. And voila, I can guarantee you, you'll start reducing your false entries pretty quickly and quite easily. So timing and tendencies.
Yeah, that's really quite a substantial difference there at the bottom table. You've got Wednesday long minus 200% and Friday long plus 1,000. That's a huge difference.
Right. Yes.
So dramatic.
Yes.
Yep.
And that's because overall, I said that some days in indexes are rather on the short side, and overall doesn't apply necessarily to Russell 2000. But overall, if you do this analysis on all indexes, you will see that overall Wednesday is a short day in indexes. So that's not surprising. So again, coming back to the secret formula, which is know your market. And if you know your market and your sector, you will naturally realize there are some very strong tendencies which you can very quickly and easily use to start improving your false entries.
Yeah, well done, Thomas. There's a couple of questions or comments in the chat. So let's put these up here. Neil's here. G'day, Neil. Good to see you again.
Neil. Great to see
50
you.
and 200 SMAs are the two I hear about the most. There's a second part to this. Self-fulfilling prophecy, since so many pay attention to those two SMAs.
Right, correct. And I have to say 200 works well as well. Both of them work as well. I tested, and surprisingly, they work on other markets as well. So, I'm not a big fan of trading cliches, and usually they do not work. And most of them fail immediately as you start testing them. Surprisingly, these two are usable. I'm not saying they're perfect. I definitely discovered way better ways to work with like this with tendencies, but they do have some positive impact, that's for sure.
Yeah. Another question here from Shark. Here we go, coming up on the screen. Do you use these filters as part of the DMP process or to reduce drawdown once you have a robust strategy?
This is a little bit more complicated in our hedge fund because my philosophy is that a good filter, good tendency can prove on a big amount of strategies. So what we usually do, we have a database with a lot of strategies, and you can get back in this series and watch a lot of other previous sessions when I was talking about strategies from our hedge fund for every market sector. But overall, let's say I find some bias or some tendency or timing for indexes. So the way I like proving it is that I ask my hedge fund team, please run it on all the index strategies we have in the database, which is hundreds of strategies. And then we like to confirm it on the entire database, on the entire sector database on hundreds of strategies. And once we confirm it, we usually, mostly because we already implemented it technologically, we usually use it as a master filter on top of our strategy. So it's like one master filter which decides now only long, now only short for any strategy in that given sector. But if you are totally positive about certain tendency, you can implement it immediately into the DNP process. And actually, I'm going to start some development probably in a couple of weeks already with these tendencies built into DNP. So both approaches are fine.
Yep. Good question, Shark. Thank you. So, Thomas, this process you've showed us of, looking at the tendencies on, specific days and trends and directional bias, can that be applied to other things in trading? Because obviously there's a lot of aspects to trading that we can include, lots of different filters, as you mentioned. So is this like some kind of universal process? How can we use this for other markets?
Right. It is a very universal process. I would say it's just up to your imagination what you want to track in your Excel spreadsheet, because obviously we just covered the most basic, simple one, which are also very, very simple to analyze in Excel spreadsheet. This took me a couple of hours, but you can do similar analysis on with other techniques. So you can, for example, use volatility cycles because we do cycle through high and low volatility. So you can do analysis of your market, how it's impacted with different volatility cycles. You can also use some trend or intermarket analysis. This is a universal process. Again, tendency, timing, and whatever you can bring into the category of the tendency and timing, you immediately can put into your Excel spreadsheet and very quickly model your results. So there are a lot of them. And by the way, when it comes to timing, the second T, I even developed a special timing. I call it a timing pyramid. It's a pyramid of the perfect timing. So you can really time your entries very, very precisely, and you can get it for free on smashingforcebreakouts.com. So you can download a free ebook with this timing pyramid. And with this timing pyramid, by the way, this is a real life example. On the charts you can see on the left side, this is the real improvement that was up. Above you can see, on the top you can see the strategy before, and then below you can see what the strategy result was after applying these techniques from the timing pyramid. So this is real example, and that just proves that tendency and timing can do miracles. So it does pay off to do this work in a spreadsheet, Excel spreadsheet, and then implement it, because the reward can be very, very juicy.
Juicy. That's a word I wasn't expecting you to say. Juicy. Juicy like a steak. Delicious.
Yes, exactly.
Okay, so where would you recommend people start then? Because we've got the directional bias, the trend, the timing. You've just mentioned volatility cycles, trend strength, intermarket. What's the one thing people should take away from this?
Two things. Directional bias, day of the week. This is the easiest, because it's super easy to do it in Excel spreadsheet. It's very fast and it does work. It's been their week analysis, they have been used by traders for 20, 30 years, and they still do work. And then, of course, if you want to learn more, then go to smashingforcebreakouts.com and also download this ebook.
Yep, excellent. I just put a link in the chat. Hopefully I typed it correctly. You can just click on that and go and download that free PDF from Thomas. All right, Thomas. So next up is the quote of the day. Let me put this one up on the screen and you can explain this. I like this one. This is great. This is really
Winners
good.
Don't wait for chances, they take them. So, you don't have to wait for chances, because you can create these chances or increases your chances by better understanding of tendencies and timing. That's all it takes. And if you agree, please don't forget to give us like and hit the subscribe button, so you can get more tips like this one.
Exactly. So as Thomas said, if you enjoyed what he had to share with us today, please hit like and subscribe, and the little bell icon at the bottom, because then you get notified when we release new stuff, because we got a lot of new stuff coming out very soon. And we got a huge month coming up in November as well for Index Mastery Month, I guess we could call it. That's a pretty good name.
Yes.
So
definitely hit that. Yeah, definitely hit that ring, and do not miss it, because we're going to talk about some really neat stuff about indexes, and we're going to go deeper into index tendencies and some surprises. I think some surprises that you do not expect.
Yep, exactly. I'm looking forward to that one. And if you've got any questions for the show that you'd like to see answered, obviously you can turn up live and put them in the chat, and we'll answer them right now. Or if you have something later when we're not live, you can submit your trading question to support@bettertraderacademy.com, and we might feature your question in a future upcoming show. Future upcoming, you know what I mean? In one of the next shows. All right, Thomas. Well, we don't have any questions or comments in the chat, so I think we can wrap it up for today. It's been a nice short episode, but very packed full of awesome tips. So, any closing thoughts before we go?
Just do your work and do not underestimate Excel spreadsheet. And happy trading.
Exactly. All right. Happy trading. See you again in 2 weeks' time. Breakout Trading Answered, the show for all things breakout trading. Ciao.
Ciao.